Welcome to The Explainer. Today, we're unpacking what I think is one of the most fascinating corporate stories happening in the world right now, Novo Nordisk. As of August 2026, this Danish pharmaceutical giant is the undisputed heavyweight global leader in GLP-1 therapies. They haven't just built a successful company, they've built an absolute empire that's literally reshaping global healthcare as we know it. But, as we're about to see, wearing the crown comes with some remarkably heavy burdens.
So here's the central mystery we're going to unravel today. Does unprecedented market dominance guarantee soaring profits? Now, intuitively, you'd think the answer is an obvious yes, right? But in the world of large-cap pharma, logic doesn't always flow in a straight line. Right now, Novo Nordisk is caught in this wild clash between a flawless product launch and a plunging profit profile. How exactly does a company win the entire market but lose on the bottom line? Let's get into it.
Section 1. The Central Contradiction. We've got a really stark contrast going on here. On one hand, you have commercial execution that is just flawless. I mean, the historically unprecedented launch of the oral Wegovy pill was a masterclass. But weighing down that incredible success on the other side is a pretty harsh reality. We're talking severe margin compression, mounting competitive pressures, and some really significant pipeline setbacks. It's a classic corporate tug of war. The big question for anyone analyzing this company right now is whether that undeniable commercial dominance actually justifies the substantial risks pulling it down. Section 2. Q2 2026 Growth versus Profit. To truly understand this dynamic, we need to look under the hood, past the flashy top-line revenue, and dig directly into the underlying unit economics. The top-line growth is absolutely undeniable, 78.5 billion Danish kroner. That's about $12.1 billion in adjusted sales for the quarter. That represents a rock-solid 7% growth at constant exchange rates. Adjusted operating profit also went up by 11%. And what drove all this? Volume. Pure, unadulterated consumer demand, specifically for their obesity portfolio. It's an incredibly healthy sign that people desperately want what Novo is selling. But then we hit a massive wall. Take a second to process this number, negative 21%. In the exact same quarter where sales volume was surging, Novo Nordisk's net profit actually declined by 21%. This is that cognitive dissonance I was talking about earlier. Volume is growing rapidly, but it's fundamentally failing to translate into proportional profit. So how does that even happen? Here's the anatomy of that 21% drop. First off, gross profit margins tanked by a massive 450 basis points, down to 78.2%. Why? Well, they're realizing lower prices due to their payer mix, and on top of that, they are spending an absolute fortune on high manufacturing costs as they race to build enough capacity just to meet the demand. We also have to factor in a one-time non-cash impairment of 6.3 billion kroner tied to pipeline assets, specifically Malunabant. All of this led the company to update its full-year 2026 guidance. And, while they improved their forecast slightly, they're still guiding for an adjusted sales and operating profit decline somewhere in the range of 0% to negative 6% for the year. That's a contraction, plain and simple. Section 3. Wegovy, a double-edged sword. Which brings us to the most fascinating driver of this entire phenomenon. It's the ultimate example of this volume versus value paradox. The oral Wegovy pill. This launch has been nothing short of a masterclass in commercial scaling. Since making its U.S. debut in early January of 2026, the oral Wegovy pill hit over 200,000 weekly prescriptions, making it the fastest launch in GLP-1 category history. By August, total prescriptions had blown past the 5 million mark. 5 million. I mean, to put that in perspective, that's roughly the entire population of New Zealand getting a prescription in just a matter of months. The sheer scale is staggering. And that represents sheer, unadulterated market dominance. The Wegovy pill commands roughly a 90% share of the oral obesity market. 90%. Novo is absolutely winning the battle for new patients. They aren't just taking market share. They're successfully expanding the total addressable market, bringing in millions of new, treatment-naive patients who were previously just sitting on the sidelines. But this brilliantly illustrates the catch-22 they're caught in. Because adoption was so incredibly fast, a significant portion of those new users were self-pay or lower reimbursement patients. So to improve access for this massive new demographic, Novo had to announce drastic 2027 list price cuts for both Wegovy and Ozempic in the US. So by winning the volume battle, they've actually squeezed their own cash flow and severely weakened their pricing power. It is a genuine double-edged sword.
Section 4. Competition and pipeline risks.
Now, Novo isn't just battling its own economics. It's battling external antagonists and its own internal vulnerabilities. The competitive landscape is arguably Novo's single largest risk factor right now. Eli Lilly is definitely not standing still. Lilly's Zepbound continues to gain critical market share, specifically in the highly lucrative Medicare channel. And Lilly's oral drug, Foundayo, actually offers a competitive edge because it has fewer dosing restrictions than Wegovy's pill. Meanwhile, Novo's internal pipeline has been, frankly, disappointing. Their drug Ziltivekimab flat out failed in a late-stage clinical trial, and CagriSema, it showed poor head-to-head performance when tested directly against Lilly's Zepbound. These clinical missteps are significantly weakening Novo's long-term narrative, which leads directly to this pretty terrifying reality for the company: structural vulnerability. The patent for semaglutide, which is the golden goose underlying all these treatments, expires between 2031 and 2032. That is a massive patent cliff approaching fast. Novo is currently way over-reliant on this single franchise. They are pouring money into R&D, absolutely, but they desperately need to demonstrate a convincing next act before that cliff arrives.
Section 5. Wall Street's verdict.
So how is the broader market digesting this really complex mix of historic sales, plunging margins, and pipeline misfires? Well, it all builds a picture of intense market caution. The consensus rating on Novo Nordisk is currently a hold. The average analyst price target sits at about $47.49, which implies less than a 2% upside from the current price. Major firms like BMO and Berenberg maintain a hold at $47. Goldman Sachs is even more cautious at $44, and TD Cowen has staked out a notably bearish stance with a $42 target. Berenberg actually cited that Medicare dominance by Eli Lilly we just talked about as a key factor limiting Novo's upside. At its current valuation, Novo trades at roughly 11 times forward earnings. Now, on paper, 11x is not an expensive stock for a company with this kind of market share. But here's what that number is actually signaling to us. The market is effectively saying that all the risks we've discussed, the margin erosion, the fierce competition, the pipeline uncertainty, they're already fully baked into the stock price. So where do we go from here? We started the year with the historic debut of oral Wegovy, and then August brought the harsh reality of that margin squeeze. But looking forward, there are immediate catalysts on the horizon. Risk-tolerant investors are keeping a very close eye on the capital markets days scheduled for September 21st, 2026. And later in the year, we have the potential FDA approval of CagriSema. Right now, this stock is firmly in a show-me phase. The market is in a wait-and-see mode until Novo can prove a clear path out of this holding pattern, either by regaining their pricing power or delivering a brand-new blockbuster drug. Which leaves us with this final, provocative question. Is Novo Nordisk's obesity empire a long-term triumph where sheer volume eventually wins out? Or are they caught in a margin trap, permanently forced to sacrifice their profits just to keep the crown? The commercial execution has been an absolute masterclass, but the future is definitely clouded. How this standoff resolves will likely define the entire pharmaceutical industry for the next decade. Thank you so much for joining me for this explainer. Keep asking those hard questions, and I'll see you next time.